We'll start with budgets. What is a budget? We have to understand that there's a difference between a budget and a forecast. A budget is a plan for future, which is based on sometimes previous budgets, and a lot of planning has, been done for making a budget. But when we are talking about a forecast, it's just a random prediction for future. It is not necessarily highly organized. It's just um, you know something which is predicting, forecasting future patterns in sales sometimes, or of cash or anything like that. But when it comes to budgets, they are strictly organized according to companies' requirements or a country's requirements. They are plans for future. So a budget is a financial plan for future. A budget is a financial plan for future, which obviously, uh, when it comes to most of the budgets, is going to identify the incomes and expenses associated with an organization or with a particular project in some circumstances when the budget is being made for a particular project or venture only. So budgets are plans for future containing future incomes and expenses. And there are various types of budgets. We are going to discuss them. One of the budgets is called fixed budget. It is a budget which is in which all the incomes and expenses are completely pre-allocated or predefined, and no changes can be made to a fixed budget. There is no room for changes in the fixed budget. It cannot be changed according to changes in business activity. It is just a budget which is completely fixed or stagnant in nature. Just like the pocket money of most of the people, when the fathers are really strict, they are just going to have a fixed budget. You are not going to get more money than that. Okay, after that we are going to talk about flexible budget, a fixed budget, and then a flexible budget. A flexible budget is a budget which can be changed as per the changes in market conditions or changes in business activity level. For example, if there is boom in the economy, the business is able to exploit the demand in the market. In that case, more production needs to be done, and in that case, the flexible budget is going to allow the business to increase its budget. And if there is recession in the economy, then you need to produce less, and in that case, you are able to reduce the budget because it is flexible in nature. So that is what flexible budget is all about, where changes can be made as per the current business activity. Then you have a budget which is called zero-based budget. A zero-based budget is a budget which is built from scratch. It is not based on any previous budgets. Each item in a zero-based budget is completely justifiable. You have to justify the need for a particular income or a particular expense in a zero-based budget. That is where we are talking about a budget which is built from scratch and is not based on any previous budgets. Then we have a budget which is called incremental budget. An incremental budget is a budget which is based on previous budgets or which is a variation of an existing budget. Normally, when a previous budget is increased by a certain percentage, we are talking about incremental budgets. Simply it's a variation or an increment of the previous budget, incremental budget. Then we talk about budget variance. What is budget variance? Budget variance is when we are trying to implement budgetary control. When we are trying to implement budgetary control, that is, we are trying to check whether the budgets are being met or not. So budget variance is checking, is comparing the standard values, is comparing the budgeted or standard values with the actual values. When it comes to incomes, that is sales, you were supposed to sell goods worth 100 million and you have ended up selling 110 million, which means that 10 million is the variance, and that is a favorable variance because you have sold more than you were expected to. So in incomes, if actual is more, it is favorable. If actual is less, it is unfavorable or adverse. In expenses, on the other hand, if actual is more, it is adverse, and if actual is less than budgeted, it is what you call as favorable. So this is budgetary variance and other, uh, variations of budget. What are the advantages of a budget? The advantages of a budget are basically it gives target-oriented work, which according to Alton Mayo creates motivation. So target-oriented work resulting it is a non-financial reward which creates motivation. Monitoring and evaluation is possible because now you can monitor and evaluate the incomes and expenses. So budgetary control is possible, like we just said. And then what else is going to happen? When budgetary control is possible, efficient allocation of resources is going to take place, which means better liquidity, better working capital management is going to be there. When budgets are made, we have assessment of performance not only of individuals but of departments, which is possible, and it helps the business in improving its overall performance and productivity, because now we are able to assess performance of individuals and departments separately. It helps in management accounting. Mostly budgeting is part of management accounting, and it helps in improving the policies and procedures for future. And yeah, that's pretty much about it when it comes to advantages of budgets. After that, we are going to talk about contents of published accounts, which is the last chapter we are going to touch, because chapter 32 is on ratio analysis and 33 is investment appraisal. So both numerical concepts which we have covered already, you know, and different classes in different classes. So we are just going to talk about contents of published accounts. Uh, Now everyone knows that there's a concept of annual journal meeting. Annual journal meeting is a meeting uh, which is to be held by public and private limited companies at least once a year. It is mandatory, and without it, they cannot really continue. They have to conduct that meeting once a year. And in that meeting, shareholders are able to cast their votes regarding strategic planning and other factors. So, in order to implement those strategic plans, the votes are casted by shareholders on the annual general meeting. Now, on the annual general meeting, we tend to decide quite a few things, and the published accounts are also usually presented in those meetings. And the published accounts, they contain various parts. They have various things. They are also sometimes called annual report as well. So when we are talking about published accounts, the first part is going to be the chairman's statement. The first part is chairman's statement, where the chairman is going to give an overview about the performance of the business in usually, a single page statement where he is talking about the performance of the business briefly. Then the second part of published accounts or annual report is where we are talking about what you call as uh, director's report. Different directors are going to put forward their reports. Each director controls different department, so each director is going to put forward his or her report briefly regarding the performance of his or her department during the previous year. So the first part of published accounts is chairman's statement. The second part is director's report. The third part is what you call as auditor's report. The auditors are going to give their endorsement regarding the reliability of accounts. Maybe they are going to endorse them. Maybe they are going to give a qualified report where a lot of errors and frauds and concealments have been found in the accounts. In that case, the auditor report is going to be qualified, which means that uh, the accounts are not reliable and they are not being endorsed by the auditors. Auditors are third parties who check the reliability of accounts. And then the fourth part is what you call as income statement, and then statement of financial position. And then we have the cash flow statement and notes to the accounts which are present inside the published accounts. So we have chairman's statement, then we have director's report, we have auditor's report, and then finally we have other parts which are income statement and statement of financial position and cash flow statement and notes to the accounts, which are basically, annexures or attachments of or detailed versions of income statement items or balance sheet or statement of financial position items or cash flow statement items. Are, a detailed account of each of the items is written in notes to the accounts. This is what published accounts are all about, and that is where we are going to end the fifth unit.